Why is it more difficult to qualify for a mortgage when you're self-employed? Well, the answer to that comes down to the very basic concept of gross versus net income. So, when you're a regular W-2 wage earner, meaning that you get a paycheck, we calculate your gross income. So what that means is if you make $20 an hour times 40 hours a week, that's your income. That's what your bank and your loan officer is going to use to qualify your debt to income ratio. Now, you're still going to have a lower take-home pay because you pay income taxes, you probably contribute to a retirement plan if you can, you have insurance and medical benefits. So your true take-home pay is a lower number. That's the basic idea of net income when you're self-employed. So take that same example. Somebody makes $20 an hour times 40 hours a week or the equivalent, but they're self-employed. So at the end of the year, they take their 1099 to their accountant, and then they go through a list of their expenses, or what are called deductions. So that $800 a week that they're making after they write off all of their expenses and deductions, they might only be making $500 a week in their take-home pay. That's basically the difference between gross and net income and why people who are self-employed have a little bit of a tougher time qualifying. It's just important to understand the differences in your income and what you can qualify for. A lot of banks will look at 2 years of your tax returns and use a 2-year average. But there are also some alternative options that is always good to speak with your loan officer about and see what you can qualify for. I work with a lot of self-employed borrowers. This happens to be my specialty. So if you have any questions or want a review of your taxes, feel free to contact me anytime.